Hi, we're going to do a series of videos on the topic "The World is Different," and this first one is going to be about taxes, an introduction to that topic. Obviously the world has changed in a lot of ways, but it's changed in some ways that we're not always aware of or familiar or adjust to our benefit. Let me set the stage a little bit. Following World War II, a lot of GIs came back from the war, and they were given a GI Bill. And so for the first time in the history of our country, they were able to go to college and get an education. At this time, our economy was starting to expand. There was a lot of manufacturing. And for the first time, there was sort of a new employment opportunity, middle management in corporations. And along with all of that came, better salaries, group benefits, health insurance, for the first time pensions for the majority of people. And with some pretty good income came discretionary income. So the middle class for the first time were able to invest. It really was the creation of the middle class. And along with these opportunities came middle class habits, both consumption and saving. And sometimes habits are hard to change, even when the world has changed. So let me give you a visual example and then go into my first topic. I want you to picture a stop sign. So you come up to an intersection, there's a stop sign. Just look at it in your mind. What two colors are on the stop sign? Say the colors to yourself or out loud. What two colors did you come up with? Likely red and white, correct? And you are correct. Stop signs are red and white. They always have been. I suppose they always will be. Good. You passed question number one. Question number two. Come up to a different intersection, and this time there's a yield sign. What color is the yield sign? Picture that in your mind. Think of the two colors. What are they? Black and yellow, right? Is that what you pictured? A triangle, a black and yellow yield sign? Yield signs have not been black and yellow since 1972. That's when the U.S. went to international standards, and now yield signs are what color? Red and white. Can you picture that now? So things change, but we don't always adjust to them very well. And I think what has happened as things change, the wealthy have had the opportunity to change and maybe the advice to change, so they've adjusted. And a lot of times the middle class haven't adjusted as well because they don't always get the advice. So today we're going to talk about how taxes have changed, and I want to show you a tax return to give you an example of this change. I've got an article here from August 5th, 2014, and the first line on the article says, nobody wants to pay taxes, obviously. But the headline says actually there's a zero tax on long-term capital gains and qualified dividends. Well, that's cool, a zero tax. So let's talk about this zero tax a little bit. Here's a tax return, and it used to be that you would put your income on different lines, and it didn't matter which line it went on. They were all taxed at the same rate. You just added up, you got your adjusted gross, and that determined what tax bracket you were in and your rate. But it didn't matter what type of income you have. It was just how much. Well, let's look at this a little bit. In this example, we've got Mr. Investor, and he's got $2,500 of interest income. He's got $10,000 of long-term dividends, qualified dividends. He's got $50,000 of long-term capital gains. So Mr. Investor has sold some stock, and he's got to pay taxes on the dividends, and he's got to pay taxes on the capital gains. Now, be mindful, the stock he sold was not inside an IRA or 401k. This is an outside investment. So he sold that, and it shows up on his tax return. In addition, he's taken $10,000 out of his IRA, and that shows up. He's getting Social Security for he and his wife of $36,000, and 85% of that's being taxed. That's the maximum that can be. So you add up all those numbers, and it's $93,100. So that's his adjusted gross. Now, before we look at page 2 at his tax, what I want to do is compare Mr. Investor with Mr. Blue Collar. So now, instead of interest income on a bunch of money in the bank, he's working part-time, getting $2,500 of earned income. He doesn't have any investments outside of his IRA. He wasn't ever able to save that. So he's taking $40,000 out of his IRA, and fortunately he's got $20,000 in a pension. Now notice that's $60,000, just like Mr. Investor has $60,000 coming here. In fact, Mr. Investor has $70,000. He's also got some long-term capital, or excuse me, qualified dividends. In addition, they have the same Social Security, so their adjusted gross is exactly the same thing, $93,100. You would imagine that their taxes are the same thing. So let's look at page 2. For Mr. Investor, again, his adjusted gross is $93,000. Let's assume he's got deductions of $20,000. So we go to $73,000. He's got 2 exemptions, $7,800. So he pays tax on $65,300. Well, his tax is $533. Pretty surprising. I mean, that's not, you know, a 10% tax bracket would be $6,500. He's almost in a zero tax bracket. Well, remember that headline, zero taxes for capital gains. He's getting a lot of income and paying very little taxes. He's taken all of that from his investments. Now, let's compare that with Mr. Blue Collar. So let me go to page 2 of Mr. Blue Collar. There's his $93,100. There's his $20,000 of deductions, so he's at $73,000. There's his 2 exemptions. His taxable income is also $65,300. However, his taxes are almost $9,000. See, the tax rules have changed, and obviously the wealthy that have investments outside of their IRAs have been able to adjust to that, and they've not only been able, they've done it. And so they use a lot of tax strategies that minimize their taxes. The average folks that don't have a lot saved outside of their IRAs, they feel like things are stacked against them. In some ways it is. But it's not just a matter that they can't do all of this, they haven't adjusted. There's some things they can do. It's a matter of being mindful and aware of it and getting good advice to help you do it. So I just wanted to give a very dramatic example of how different taxes can be from the same income, and illustrate how important it is to adjust to changing tax laws. For some, that might seem kind of discouraging, and it's easy to conclude that, yeah, taxes have changed, but not for me, it benefits other people. That's a little bit like continuing to believe yield signs are black and yellow. Tax rules have changed, and maybe not all the changes will benefit everybody. But if you're not mindful of the changes and you don't adjust to what you can adjust to, you're overpaying taxes. So that's why we believe taking taxes into consideration is very important in retirement planning, particularly coordinating with your Social Security benefit and how you draw income. So I just encourage you to do all that you can to adjust to the changes in ways that are favorable to you. Thanks.